Bismillahirrahmanirrahim. Assalamu alaikum, everyone. My name is Yasir Yamin, and I welcome you all in this session. Guys, in today's session, we will be talking about some areas which might be examined in your upcoming SBR exam. All right. So we are aware that whenever you go into SBR, there is at least some portion of your exam which is not classical stuff. It's stuff where which you can call current issues or which you can call other areas, and these other areas might become part of your exam, and some of these areas I really want you to know beforehand you go into the exam. All right. So we'll make sure that we keep it quick, we keep it in a discursive manner, and we conclude our agenda without taking a lot of time of yours. All right. So I think let's begin. So there are some areas which I want to discuss I want to discuss with you. And one of the first areas that I will be discussing with you is about management commentary. So guys, throughout our course, we got to know that in today's time, investors are not only looking for financial numbers. So the financial accuracy and financial reporting has matured over time. So we feel that the current accounting standards are pretty much up to date, and current accounting standards rightfully address the concerns of variety of stakeholders. We have IFRS 9 that is made out of a certain agenda. We have IS 37, IS 38, we have IFRS 16 and IFRS 15, and many accounting standards that particularly well address the concerns of shareholders. But in recent past, many of the investors and many of the regulators and many of the other stakeholders have raised their concern that these accounting standards that we were praising a while ago have become so complex that the ethos of financial statements is somehow missing. You see, financial statements were not only prepared with the view that shareholders get the comfort level that the business that they have invested in is compliant, is not making any frauds, and there is no mismanagement there. That was one angle of preparing financial statements. But the other angle was that shareholders and other investors and potential stakeholders, while making their investment decisions, they wanted to know the strategy moving forward. So one of the weaknesses of today's financial statements, today's classical financial statements, is they are too much focused on history. Yes, they show how compliant a business is. Yes, they show what's the risk management strategy. Yes, it might show, how well is the liquidity and how well is the profitability and what about gearing and things like that. But in today's time, the competition is so stiff that investors really want to understand how businesses are being managed in terms of future outlook. You see, just look around you what's happening. I mean, I saw, I saw a video of Joe Kesser. Now, how I know Joe Kesser? Joe Kesser was the ex CEO of Siemens Germany. And now he's the chairman of the board of Siemens Energy, which is a separate entity. Now, I saw his interview on LinkedIn, and I saw that he was talking about the outcomes of Davos meeting. You know that there is a meeting in Davos where they talk about climate, and global leaders come there, global business leaders come there, they have their interaction, and then things like that. So I was, to my surprise, what Joe Kesser said, actually it was very much surprising for me, I would say. Now, Joe Kesser, who is a well-known, executive all over the world, he had been heading one of the largest companies of the world, and he was so blunt. He said, this time Davos meeting was all about America, and it was all about China, and the possible rift that they are going to have once tariffs are in place. And up till that time, it was fine. But then he said that Europe is long gone. These are his words. This is what I got from his language. So he said, Europe is long gone. And if I was the chief executive of Europe, I would really start, jotting down a plan and write down where Europe is going wrong because of their involvement in a particular conflict between Russia and Ukraine, and what are the potential impacts that they will have if US imposes sanctions, or US imposes tariffs on European entities, and so on and so forth. He talked about that there is missing investment in infrastructure. Now, we guys cannot even imagine that. I mean, he's talking about Europe and he's saying that there is missing investment on infrastructure. I mean, people travel from this part of the world to that part of the world just to see the infrastructure. And he's saying that there is missing investment in that. And then he was talking about that there should be investments on education, that there should be investments on defense, and things like that. So what I'm trying to make you understand, that the business position is so volatile nowadays, with China coming into play, with India's economy expanding. India is one of the potential upcoming superpowers of the world. So there is some play within Asia. Then there is Japan, there is US, there is Russia, and then there is Pakistan, and things like that. Then there is Saudi Arabia. And there are potential conflicts happening, and businesses need to adapt to this environment. They need to plan their prospects, and they need to plan their future accordingly. They are in this environment. And then there are some actions which have been taken with regards to climate, and businesses have to comply to those actions. Now, all of this information is very important for any company's management to focus on. But what about investors? How will investors get knowledge about all of this? How will they know if the business they're investing millions of dollars in, or billions of dollars in, how that business or that business's management is going to react to that? Yeah. So how business is managing such an environment? I mean, just imagine when Donald Trump became president of US, there was a news that TikTok will shut down in US, and TikTok is making a lot of money from US. So just imagine if you're an investor in TikTok, and then there is a political change and that affects your business, and all of your money could go down into the toilet. You could lose your money. So you, as an investor, you would be very careful where you are putting your money in. And if you really want to make sure that your money reacts, or your money is compounded over time, and your money is your money is maximized, your wealth is maximized, you want to know how the business is performing. So over this period, many regulators and many investors and many stakeholders have asked for some management commentary. Now, management commentary basically is a narration which tells about the business. This is beyond numbers. So this is essentially non-financial information that should be provided by the runners of the company to the owners of the company and to the wider stakeholders, in which they should talk about how the business is going, what sort of strategies are in place, how they are going to react to political changes, how they are going to react with business changes, how they are going to react to artificial intelligence, let's say, and how they are going to react to climate change, and so on and so forth. So it's basically a narrative report which should provide sufficient information to shareholders so that they can make their investment decisions. Now, regulators had been calling for this information since long time. While previously there was no specified format in which this narrative information should be given. So IASB, which is International Accounting Standards Board, came up with a set of they came up with a format in which companies should be providing this sort of information to their investors, so that investors can make meaningful decisions. So management commentary is basically it's basically a template which public listed companies or larger companies can follow, so that they provide narrative information or non-financial information or futuristic information to their investors in a specified format. All right. So management commentary is like ISB has provided a non-binding guidance document that is intended to be applied by publicly traded companies. The regulators are promoted to adopt the guidance with or without modification. However, you need to note this down with you. However, it is their sole discretion to decide which entities need to follow this. So, what is management commentary, guys? Management commentary is a narrative report that needs to be provided alongside your financial statement. So, it basically acts as an add-on to your financial statements. So it's nothing like IAS or IFRS. This is a separate effort being done by IASB just to make sure that the financial statements still stay relevant for their investors, and that they could understand the business, their strategy, their structure, and then they go on to the financial statements to corroborate this information. Yeah, and this is a sincere effort done by IASB. Let me come back to you, Rohit. So this is to be provided alongside with financial statements that particularly provides commentary on entities' prospects and other information which is not part of your financial statements, right? So actually, what are the key objectives of management commentary? First of all, you need to remember that management commentary is only a white paper, you can say. It's only a template, you can say. It's a non-binding, and it's a guidance document only. So it's not like IAS or IFRS. ISB is just providing a particular template which public listed companies may follow in order to provide sufficient and appropriate information to their investors so that their financial statements stay relevant. But what are the key objectives out of this? The key objectives are as follows. They want to make sure that there is enhancing of financial reporting. So they want to provide additional context to the financial statements. So I mean, you guys even cannot even understand the examiner's question if you are not told what industry the business is actually in. Just imagine, I mean, your boss comes to you and asks you to appraise a particular set of financial statements, and then you ask your boss that which company basically these financial statements belong to, and your boss says, I don't know. I mean, how the hell are you going to provide meaningful suggestions and meaningful advice if you don't know about the industry, if you don't know about the business, if you don't know about the management structure, if you don't know what risks does this business have? Now, investors cannot take decisions if they do not know about the company. So basically, this provides additional context to the financial statements. This is one of the key objectives of management commentary. It will help improving decision making for investors, offering useful information to capital providers and stakeholders. It should provide forward looking information. Remember, it should provide forward looking information. So it should explain future business prospects, risks, and opportunities. For example, a company might be explaining with the advent of AI what they intend to do, how they are modifying their portfolio, what type of softwares or what types of digitalization they are going to introduce to accommodate themselves. Yeah. So each and every acquisition that you make, you need to provide commentary so that people can understand, okay, this time you're preparing consolidated financial statements in accordance with IFRS 3 and IFRS 10, but additionally they want to understand why did you acquire the other company. Despite the fact that we want financial statements just to make sure that our money is in safe place, but we also want context. Why are you acquiring the other company? Yeah. And that may be in another country, but we want context. Yeah. So that should be forward looking information. Okay. In 2011, there was another exposure draft issued by IASB in which they extended their original objectives and included these three items as well. As the world has been progressing, management commentary now includes three further objectives. And these objectives are: there must be some connectivity between financial information and non-financial information. So during your management commentary, you might be referring to a particular disclosure, right? Like, for example, you're saying the blah, 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 see operating segments disclosure on page XYZ. Yeah. So you want to corroborate information so that it is understandable for your investor. He can understand what the financial statements actually represent and what's the context behind it. right? So there must be sustainability related disclosures and their impact on financial statements in this proposed management commentary. And there can be better alignment with investors' needs, integrating external reporting requirements such as ESG disclosures. We are going to talk about ESG in a while, but yes, these are extended objectives of management commentary. So there is a question in which Rohit asks me, it is like APM, voluntary to disclose, if I'm not wrong. Yeah. APMs, you can say management commentary might include APMs, but the overall objective of management commentary is to provide additional information. Yes, that provides support in understanding about the financial statements, but which is also forward looking. APMs are not forward looking. APMs are just another tool or another way of analyzing the financial statements. These are not traditional ratios, but additional ratios, additional types of metrics that allow you to appraise the same company. All right. So the objective of management commentary is not the same as objective of APMs. APMs is for performance measurement, while management commentary supports futuristic decision making or future business understanding or understanding the future outlook. All right. Again, it's non-binding. Okay. Now, management commentary is part of your examinable document. And guys, since it is part of your examinable document, before you go into the exam, I just wanted to make sure that you revive this information in your minds and just make sure that you read this particular handout at least 2 times before going into your exam. Yeah, you don't need to ratify this information, guys. You don't need to ratify. You just read this total page 2 times, and if this area comes into your exam, you can just write on your own. You just need to have a high level understanding of what is management commentary, and the rest you can manage during your exam. All right. Is this clear to everybody? If this is clear to everybody, I'll jump on to the next area which I want to talk about. Everybody clear on this? All right. So I'll just move on. Okay. What other area I want to talk about? I'll come to materiality in a while, but I seriously want to talk about ESG. Now in our previous part in management commentary, we had been discussing that how important it is for investors that they get a non-financial information, they get some management commentary so that they can better understand how the business is coping up with the environment and how the business is coping up with the technological changes and the environmental requirements, right? So we understood how much non-financial context is becoming important in financial reporting. Yeah. So this is another area which has been many a times promoted by different type of stakeholders and lobbyists. So specifically in Europe, because they are highly affected by climate change and western part of the world especially, and those are those type of economies and mindsets, they always talk about the future. So there is a term in the market where everybody is talking about ESG reporting. ESG means E for environmental, S for social, and G for governance. Now, there have been multiple efforts. There have been multiple efforts by various type of lobbyists and various type of stakeholders. They all of them wanted to provide a template according to which companies provide non-financial information, descriptive information you can call. And one of the ideas was to comply with ESG reporting. According to a study based on more than 1,000 companies, there is high correlation between ESG implementation and the share price. So companies who make sure that they provide ESG report, have higher share price, because investors nowadays are too much cautious where they want to make sure that they are investing in futuristic businesses and they are not investing in businesses that pose a threat to the environment. So companies who provide ESG reporting have higher share price and have higher volatility or higher demand of their shares, as compared to those who, or as compared to those companies who do not do ESG reporting. So ESG reporting is, totally relevant for companies nowadays. So ESG basically involves providing narrative information. Narrative information about what? Narrative information about three things, and these are all non-financial. You need to talk about in your narrative report about environment, you need to talk about social, and you need to talk about governance. Now these three areas are those areas which are not routinely discussed or can be implied through your traditional financial statements. Now when you talk about the heading of environment, environmental reporting means that the company reports the exposure to the environment. For example, in that particular paragraph or in that particular heading, your chief strategy officer or your chief environmental officer or your chief sustainability officer or your chief executive officer should talk about, what is the relationship of the company with the environment. I mean, what is your company's carbon footprint? Are you carbon neutral, or are you carbon negative, or are you carbon positive? You might talk about how much money, the company has to spend buying carbon credits. Is anybody aware of what is carbon credits? What is carbon credits? Companies who are more compliant. No, Farah, it's like a carbon tax. Companies who are not more compliant with environmental regulations, what they need to do is they need to sort of pay a fine or a penalty to the government. And how this actually works is, let's say there are two companies, A and B. Now, A company is environmental friendly and B company is not environmental friendly. So A company will get like some carbon credits, which they can use offsetting their taxation, maybe. Yeah, they can use these carbon credits to offset their taxation. Yeah. And then there is B company, and this is not carbon friendly. They are actually polluting the environment. So the government or the regulator says that you need to buy some carbon credits. Either you buy this thing from the government, so you pay direct penalty to the government, or you can buy this carbon credit from a company which has carbon credit, and that is a company which is more sustainable. So in this manner, A company will benefit by selling their carbon credits to company B. It will act as if it is a penalty for company B, but it will act as an income for company A. Now, your shareholders would want to know if their money is being utilized to buy carbon credits. And where will you report this information? This might be financially immaterial within the context of size of the company, but non-financially this is material information. But where do you provide? There is no specific IFRS which talks about carbon credits. So where do you disclose this information? You disclose it within the heading of environmental in ESG reporting. You need to talk about if you're using renewable energy or not. There can be investments in solar or, hydel or other areas. For example, Microsoft reports this information that they have been spending a lot of money, on data centers, and they have been trying to power their data centers through renewable energy. They have been, they have been planting, they have been spending on solar panels, they have been spending on, wind energy, they have been spending on, they have been spending on research and development to generate electricity from the waves of the sea. So they have actually planted, or they have actually constructed their data center facilities within the sea, so just to get electricity from the high tides and high waves that, that sea levels have. So, this sort of information your investors want to understand, because they want to know where their money is actually going. And where do you report that information? Environmental. Does your product protect natural ecosystem? Do you follow the environment law? Now, these are some of the areas under ESG reporting which you might be, this information you might be providing to your shareholders. And not only environment, we've been talking about environment and sustainability in S1, S2, and multiple areas we've been talking about environment, and environment. But there are some other areas which are particularly relevant for shareholders as well. And like, for example, there is this area of social. Yeah. So your investors want to really understand, for example, does your company offer fair wages? Let's say your company's name is Barrick Gold. Now, Barrick Gold is one of the leading investors in Reko Diq. Now, Reko Diq is a very large project in Pakistan. Pakistan supposedly has, one of the largest copper reserves and gold reserves, and, these type of reserves available in the area of Balochistan, which is a province in Pakistan. So Barrick Gold is highly investing in that particular area in mining activities. Now, investors want to understand if, Barrick Gold is actually utilizing child labor, or are they providing fair wages, to people who are actually working on their sites, who are working in Africa, or who are working in Australia, or working in, let's say, low income countries. Because, if this information comes public, that Barrick Gold, or let's say any other XYZ company, is not paying fair wages, they are not paying fair wages to, they are not paying fair wages in low income countries, or maybe they are not paying fair wages to women, they are not paying fair wages to people of a specific color. If all of this information becomes public, there will be a huge outcry amongst public. And that, if that happens, that would deter investors in providing further support to the company, and the company might collapse. So investors want to know it in advance, whether how the company is taking care of these areas. These are sensitive areas. Let me remind you, these are sensitive areas. But if they ignite, that could seriously harm you. How many times have we seen that there are some certain issues, certain sensitive issues that happen within a country, and then they ignite riots? I mean, I'm just being apolitical, I'm just referring to a particular scenario as a business person, as I see. Something in Bangladesh happened, maybe an year ago. Yeah. A simple event actually led to riots, and then there was a topple of the government and everything changed. Make sense? So you being students, you can say, okay, sir, it is irrelevant, why should a company worry about it? But no, these are sensitive issues. If they ignite public, that could deter further investment into your company, and then your business would be shut down. Make sense? So these are sensitive areas for which shareholders want information. What about human rights, child labor or forced labor? They want to know information about that. What about community rights? There was a campaign in US which talked about Black Lives Matter, and all of that campaign affected, many areas of the world. It affected even cricket. And people would, bow down and raise their hand and say, okay, Black Lives Matter. So companies get affected when they try to misuse the social norms. And if they try to misuse the society reacts. And when the society reacts, very large businesses could come down like anything. Unilever has a hit product. They had a hit product, Fair and Lovely. They changed its name to Glow and Lovely because, as the world was progressing, they thought, okay, if our product's name is Fair and Lovely, that might be taken as discrimination against the people of color, and that could negatively harm the reputation of Unilever. And if the society starts reacting on these kind of stuff, their shareholders or their investors, whatever stock market they are in, they would stop investing in these type of companies. Yeah. And that could be a big problem for even a company like Unilever. So they changed its name to Glow and Lovely. Yeah. So they need such kind of information. What about data privacy and security? I mean, you guys might have seen this hearing, the Congress hearing that happened in US, whereby Mark Zuckerberg, who is the technically who's the CEO and the rightful largest shareholders of Facebook, he was questioned a lot on data security and privacy. Same goes for Google. So, data privacy and security, your investors want to know how you are making sure that whatever customer data you acquire as a result, is being secured, and that is carefully handled. Yeah. Then there is one area which talks about governance. Yeah. So in governance, your investor would want to know what is the board structure and leadership. When your investors know about the board structure and leadership, it creates trust within investors, employees, and your customers. Yeah. They would want to know what sort of ethical practices is the company following, because the more ethical management is, the more ethical the business environment or the corporate environment it is. It reduces the risk of fraud, corruption, and mismanagement. So they would want to know what sort of ethical guidelines are in place within the company. Does the company comply with whistleblowing policy or not, and so on and so forth. Yeah. And then you might report about shareholder rights, executive compensation, etc. So in the governance area, and this might give a hint to your shareholders about the long term sustainability of the business. I've heard about many businesses that just failed due to the governance structure. Can anybody of you tell me any company or any corporate that was within the limelight, or it was a very good business, but it did not succeed due to the management culture and the governance failure? Can anybody name a company? I mean, the most famous scandals was Enron. So in Enron, the whole management structure was like that. The chairman and the CEO was one person. You might study about this in SBL, but chairman and the CEO was one person in Enron. So basically, if you are the chairman and you are the CEO of the company, and you decide which directors get how much money and who gets to speak in the board of directors meeting and who does not, who is not allowed to say anything, within the board. Now, he was a don in the company. And since he was a don in the company, he actually made sure nobody speaks anything during the board meetings. Yeah. So whatever he was doing wrong with the company, that was silently allowed. Nobody questioned it. Yeah. So shareholders have seen in the past that very good companies, very good products, very good services, but they go down if the management style and management structure is not good. If the company is not being governed properly, it will go down. We have an example here in Pakistan of a company named Hescol. Yeah. So Hescol, Satyam case, for example, Hescol in Pakistan is a very recent case whereby the company, you are in oil and gas industry. How can you go down? But there was the governance structure was such that, everybody was a don. There was mismanagement, there was creative accounting, but nobody in the board was talking about it. Because if you want somebody to talk about it, you need non-executive directors on the board, you want independent directors on the board, you want the chairman and the CEO to be separate persons, right? And when investors get this sort of information, they feel comfortable if the company may go in the right direction or not. Make sense? Yeah. So I can name you various companies that with good products they came down just due to the governance structure. Yeah. So the ESG strategy should be, how should be the ESG report? It should be authentic, it should be implemented and believed by the board. And narrative reporting should be done. That should be the ESG strategy. Now, although that many a times accountants do not feel comfortable whenever I talk about such type of narrative information, because all of this is theory. But believe you me, if this comes as part of your ethics question or as part of your question number 4, and you have not listened about anything about ESG reporting, you will then remember how much marks you could have got. Now this is plain simple easy marks. If this area comes into your exam and you are not able to provide sufficient information about it, you are not able to develop a particular answer, these easy marks would go down into the toilet, and you'll be cursing yourself, I'm telling you. So that's why all of this information is very relevant. All right. Now, let me go on and discuss one other area. Before we touch on materiality, there is one other area that I want you to focus on. Now, guys, please pay attention. Please pay attention. Now, during our classes, we had already discussed in detail about IFRS sustainability disclosures, haven't we? Let me know, are you well prepared for S1 and S2? Are you well prepared? You should be. Now, while for us accountants who are particularly attempting SBR international paper, for us, IFRS S1 and S2 knowledge is quite essential. But, your examiner has written this particular thing. Your examiner has said that for the SBR International UK and Ireland exam, knowledge of the differences between IFRS sustainability disclosure standards and European sustainability reporting standards is required in the following areas. This is one part of your syllabus area for which your examiner has said that you need to have high level understanding of European sustainability reporting standards. And how much high level of understanding you require? This. Only this information you require as far as European sustainability standards are concerned. Nothing more, nothing less. This table has been given by your examiner. This is not given by me. This is given by your examiner. Yeah. So there are some areas which you need information on as far as European sustainability reporting standards are concerned. I think since they are part of your current syllabus, they might be tested in March 2025 or June 2025. It is for sure. And it is highly unlikely that your examiner provides something in your examinable document and does not question about it. There is a high good chance that I always rate that sustainability will come as part of your examination, but for some people it might come with within the context of European sustainability reporting standards as well. Now, you do not need to learn any European sustainability reporting standard, but you need to have this high level of understanding whereby you understand how ESRS is different from IFRS S1 and S2. Yeah. As far as the enforceability is concerned, it is mandatory only for those companies who are already subject to reporting obligation under NFRD. NFRD is basically non-financial reporting directive. You see, I just told you that Europeans are forward looking. That's a plus side. Europeans are always forward looking. So for their part of the world, for their companies, they have compelled the companies to provide non-financial information specifically on the areas of sustainability. And for that, they issued a circular, they issued a statutory order, which is known as non-financial reporting directive. And they specified some companies who must provide sustainability related information. Not every company is compelled to provide sustainability disclosure, but at least there are some specified companies who must provide sustainability information. Yeah. So ESRS is primarily for them. Effective date is from first reports in 2025 for all large public interest companies. So basically what NFRD did, they highlighted some sectors or some areas or some companies who are deemed to be public interest companies. Now, technically, all public listed companies are public interest companies, but they specified what companies are public interest companies and therefore they must provide this sustainability information. And then there are some companies which are large non-EU companies, but they are listed on the EU market. They must also comply with ESRS and they start providing ESRS compliant sustainability information from 2025. Again, this is all you need to know. How they are going to provide disclosure, what's included in that, that's outside your course. That is covered within IFRS S1 and S2. But they have to be compliant from 2025. This is much that you need to know. What's the scope? As above, Target users, wider range of users, which include shareholders, regulators, public, etc. Coverage, we studied that under IFRS, there are two standards, S1 and S2. In ESRS, there are 12 ESRS. Two are cross-cutting standards, ESRS 1 and ESRS 2, and 10 topical standards. So basically what it is like, there are two general standards like S1 and S2, and then there are 10 company specific or industry specific standards. For example, steel manufacturers should provide this information as well. For example, cement manufacturers should provide this information as well. For example, energy utilities should provide this information as well. For example, tech companies should provide this information as well. Now, these are 10 specific areas, 10 specific industries who should provide specific information to the regulator as part of their annual reporting. Yeah. Materiality approach for IFRS, it is only financial materiality that matters, but for ESRS, it's double materiality. Now, double materiality means if a matter is financially impactful, you should be reporting it. But even if a matter is not financially impactful, but it is socially or environmentally impactful, you need to provide that information. So it's a level beyond IFRS. Yeah. Materiality, assessment, some mandatory disclosure requirement always to be applied and some dependent on materiality assessment. So there are certain, the general standards must be applied generally by all the companies in the targeted group as we discussed here. Yeah. But some specific disclosure should only be provided by some specific companies. All right. Based on materiality assessment, and that materiality assessment under ESRS is both financial and non-financial. Okay. Location of the reports has been prescribed within entities corporate reports. So there is a prescribed structure they need to follow under ESRS. And, sector specific disclosures will be developed from 2024. They are still not developed, and we are not concerned if they are ever developed or not as far as our examination is concerned. All right. So this is one area that has been specifically highlighted by your examiner. What I want you to do, just read it 2 times, maybe 3 times before going into your exam. My best guess is that your examiner might not ask you anything about ESRS, but they might provide you an ethical scenario whereby, let's say, a director of the company is saying that we do not want to comply with ESRS due to any goddamn reason. He wants to hide information as far as ESRS is concerned, and he might say that, you see, it's not mandatory. So since it's not mandatory, I do not want to report this information or that information, and it won't be a problem. You need to be aware from an ethical perspective that following ESRS is mandatory for some targeted group. And if that company falls within the targeted group, the director would not be, would not be professionally compliant if he decides not to follow ESRS. So this is one area that could become part of your exam. Does everybody understand this area? Again, very critical information. This is part of your examinable documents. It's very easy for you to shy away, but I don't want you to go into SBR for 2 attempts. Only 1 attempt and a high scoring attempt. Is it clear to everybody? Just read it 3 times and that is more than enough. Most likely, this handout that I'm going to provide you will be very helpful for you guys. Is it clear to everybody? Okay, company going to be listed soon will fall under ESRS. It may fall under into ESRS if it's a public interest company, or if even if it's a non-EU company, but it's listed in European market. Like, for example, Lucky Cement in Pakistan is listed on London Stock Exchange. They might fall under this requirement and would have to provide, ESRS compliant annual report. Even though they are not basically a UK company, but since they are listed there, they might have to comply with the ESRS. So IFRS S1 and S2 is non-mandatory, but ESRS is mandatory, not for every company, but for some targeted group. that part of information is very relevant to you. Does everybody understand this, guys? Is it clear to everybody? Is it clear to everybody? Yeah. All right. Perfect. All right. Now let's go on to one area which we have skipped a while ago, but it is one area that might be tested. And again, I think it can be tested as part of your question one theory. This is just a wild guess. Farah is asking, sir, do we need to know about those 10 industries? No, absolutely not. This is the only information, the snapshot that I showed, that is the only information that you need to know. No names. Okay. So I was talking about materiality. So materiality is one area which I think might be tested as at part, as part of question number one theory. It might be tested in question 3 or question 4 of your exam. And this will be completely theoretical, 5 or 6 given marks, just to make the other person understand what is materiality. That is it. Let me ask you guys, what do you mean by materiality? Can anybody tell me what is materiality? And anything that you explain, I would take it as is. Just talk your heart out. What do you mean by materiality? What do you mean by materiality? I'm willing to wait. Anybody can answer, and you can answer whatever you want. Because if this comes into your exam, you cannot just sit like that. You would have to answer. So answer it right here. Better. Materiality is a criteria by which an entity defines a set threshold, things that can affect any investor's decision. Very nice. Okay. Information that affects the decision of the financial users. Very, very good. Very good. Now, this is a bit formal, but let me just talk my heart out, right? So, materiality, according to me, is basically what really matters. This is it. Materiality, basically, the underlying concept of materiality is to identify or to know what matters. So, any information that matters is material. Simple. Any information that matters is material. Within the context of a company and investors, any information that matters to the investor or the shareholder or the other stakeholders in question is material. Or maybe if I extend this version, any information that could influence the decision of the users of the financial statements is material, because that particular information can influence the decision of the users of the financial statements. We think that that information matters to the investor, and if that matters to the investor, that information is material. Now, we have read in our earlier papers that there is some financial materiality, yeah, and then there is some non-financial materiality. Where have you studied about this financial and non-financial materiality? Or rather, the right wordings of this is materiality is within the context of quantity and quality. Yeah, you might have studied about quantitative thresholds of materiality in your paper audit. Yeah. And you might have studied about qualitative thresholds of materiality, with respect to frauds and errors and misstatements and misappropriations in a company within the context of qualitative materiality. Yeah. So even then, all of that information is that information which matters. Yeah. Now in SBR, nobody is asking you to calculate any quantitative materiality or qualitative materiality, but within the context of producing financial statements and providing them to your shareholders, you need to have the understanding of what materiality actually is. You might be asked to explain the context of materiality in a given examination question. So you need to know about it. Okay. So the definition of material helps a company determine whether information about an item, transaction, or other event should be provided to users of financial statements. So whatever the definition of material has been defined by ISB, let's say, materiality is anything which matters. But sir, what materiality? Quantitative materiality or qualitative materiality? What are you talking about? So ISB basically tends to define what is materiality. Because if ISB can define its version of what really matters, if ISB can define its version of materiality, it will help the preparers of financial statements in making decision what to include in financial statements and what not to include in financial statements. Certainly whatever has been written in IS and IFRS, you need to include that sort of information in your financial statements. But what about the information which is, not discussed in any IS or IFRS? Do you still talk about that or you don't talk about that? What happens about that? Yeah. So for example, if a company holds digital rights to a future auction. Now, I am for sure that if you hold some digital rights for a future auction, this is a complex transaction. Now, do you report this or not report this? How do you report this? Do you report this with completeness or do you just report it as a prepayment? If you report this holding of digital rights for a future auction of cryptocurrency or anything like that, then just a prepayment head would not explain to your shareholders, how much relevant this is. Yeah. So you need to provide context. Up to what extent you need to provide context, that you will come to know when you study about materiality and the definition that has been provided by International Accounting Standards Board. Yeah. So what is the definition actually? The definition is as follows. There was an old definition of materiality, and that was like, information is material if omitting or misstating it could influence decisions that users make on the basis of financial information about a specific reporting entity. Now, previously, ISB gave a definition of materiality in which they said that any information is material if it was omitted or misstated, could influence the decision of the users of the financial statements. Any information which, if either is omitted or is misstated, will affect the decision of the user of the financial statement is material. So the onus of this assessment of materiality was on the accountant. Now, accountant had to ask two things. If I do not provide this information, if I omit this information, will the shareholder be making a wrong decision about the company? If I misstate this information, will the shareholder be taking a wrong decision about the company? So the onus is on the financial reporting preparer. Now, this definition was actually revised. There is an amended definition of materiality. And mind you, that the onus of reporting financial statements and determining materiality is still on the accountant. It is still on you guys. But there has been an addition to the definition of materiality. Any information is material if omitting, misstating, or obscuring. Obscuring basically means representing that information in an unclear manner. Have you seen politicians? How many of you are from like Pakistan and India, let's say? You ask information from your politician. If you ask them A, they will talk about Z. Yeah. So what they are basically doing, they are obscuring their answer. They're answering your question, but in a manner in which you get confused. So obscuring is like you are providing information. So you are not omitting it, you are not misstating it, but you might be presenting it in a manner which is unclear, which is confusing, which is neither which is neither a truth or a lie. You are somewhere in between. So if it's neither a truth or a lie, it will confuse your investor. So, the new definition of materiality includes this word obscuring. And that they have clearly said that any information which, if omitted or misstated or presented in an unclear manner, would affect the decisions of the primary users of general purpose financial statements, that information is material. The new word is obscuring, that could reasonably be expected to influence, even if you provided some information in an unclear manner that did not affect the decision of the that did not affect the decision of the users of the financial statement, but could have affected the users of the financial statement, even if you represented that information in an unclear manner, but it did not cause any harm in actual, but if it may have caused harm, then even you are non-compliant within the context of materiality. So for example, I'll explain you what I'm trying to say. Let's say Sarthak actually bought a very nice hot sports car. Yeah, he decided, once he's done with exams, he decided that I'm going to drive this car on the road of, let's say, whatever city he lives in. He wants to drive that sports car very fast. And he was driving on 140 kilometers per hour on, at midnight. A police constable stopped him and said, Sarthak, what are you doing? Why are you driving this car so fast? He said, why does it matter? It's midnight. I can drive the car how fast I want, guys. But police said, you could have hit someone. Sarthak replied, but did I? Police will take you to the police station and lock you up. Because it's not that you have actually hit a person, you could have hit a person. And that in itself is a crime. Yeah. You will not be left alone. You will not be spared just because you did not, you did not become successful in hurting someone. You could have hurt someone and you will still get a ticket or maybe jail or something like that. So it's like that driving a sports car. If a company is regularly providing, let's say, sustainability information, but it is providing information in a manner which is unclear to the shareholder, it does not even benefit the shareholder in any case. So a regulator will pick you up, ISB will pick you up, and they will say, okay, you did not provide this information in a relevant manner. It could have affected the users of the financial statements. And you would say, but it did not affect the users of the financial statements. But the auditors and the regulators and the ISB will say, but it could have. You are non-compliant within the context of materiality. Yeah. So it's very important for accountants to provide all information which, if omitted or misstated or obscurely provided, could affect the decisions of the primary users of financial statement. So all in all, the concept of materiality does not just help to determine whether transactions are recognized in financial statements, but also it's important how they are presented. Yeah, this is materiality. So if you get a question on materiality in your exam, you are just going to talk about the new definition of materiality, and you are going to talk about what is materiality, why is it important, and how it helps a preparer financial statement. Yeah. So this is just the context that you need to provide in your exam. Is it clear to everybody? And again, I understand that this might feel that, this is not actually very much interesting as compared to IAS or IFRS or the numerics that you do. But again, whatever comes into your exam is, that should be interesting for you because you are going to gain marks from this. Is it clear? Is it clear, everyone? Yeah. Now, when you are preparing for your upcoming examination, I want you to focus on one further area. I'm not going to teach that particular area, but I want you, when I provide you this handout, and I will, I want you to read these two pages. Crypto and other digital assets, I want you to read these two pages. Now, this handout is made in a self-explanatory manner. This handout, you will first get to know what is cryptocurrency, what are digital assets, what are the key terminologies that you need to understand. And on the next page, you are going to understand, you are going to get a relative comparison, which accounting standards should cryptocurrency be reported in. Now, there has been a debate where cryptocurrency should be reported. Now, I am going to conclude through this handout that IS 7 is not the right place because there are some reasons. IFRS 9 is not the right place because it's not relevant to IFRS 9. IFRS 16 is not the right place to record, holdings or investments in cryptocurrency. IS 38 is the only possible area where you can recognize your cryptocurrency or digital assets. And if you are a provider of cryptocurrency, you are going to apply IS2. All of this information has been provided and justified in this particular handout. I think based on the mock I saw by ACCA, based on the previous experiences that I've had, I think this particular information might be useful when you're going into your examination. So just read it out. Just read it out. Is it clear to everybody? The objectives should be very clear. I will be providing those handouts. If I forget, you can just ask me for this handout and I'll definitely provide you this. Is it good with everyone? I hope it really helps you. All right. This materiality concept might be tested with conceptual framework like blending. Yeah, might be. I don't know. Might be. These type of questions do come whereby your examiner simply asks you to explain a certain terminology, and if that comes, you just need to make sure if you can blend it with conceptual framework, perfect. If you cannot, just go with the simple materiality. But I think you are right. Maybe it might come within the context of conceptual framework as well. You're right. You might be giving an idea to your examiner just right now. All right. Is it clear to everybody?